Rates are to asset prices, sort of like gravity is to the apple. When there are very low interest rates, there's a very small gravitational pull on asset prices. Interest rates power everything in the economic universe.
All right, we have more changes unfolding in the U.S. economy and the U.S. housing market. Changes that have the U.S. government finding itself in a bit of a pickle and turning to who they always do when things are about to fall apart, the Oracle of Omaha. And when they call in Warren Buffett, things are bad. Well, they are bad. We're going to explain what happened behind the scenes, why Buffett was tapped, what they're trying to get ahead of, and how it's affecting the housing market in the short term. Because if you didn't hear, mortgage-backed securities last week, the bread and butter of residential real estate, the thing that lets the housing market go round, took a beating last week. We're going to cover that as well. But before we get started, if you're not already a subscriber of this channel, consider subscribing. It helps the channel out, and I appreciate your support. So what's up with our man Warren Buffett, folks? Well, he had a great week with his company, Berkshire Hathaway, announcing better than expected earnings, beating expectations, posting a $10 billion second quarter operating profit, which, by the way, comes after he warned shareholders in May that he expected earnings to fall this year, as he put it, with the incredible period we've seen for the U.S. economy now drawing to its end, he said. But overall, a great week, folks, until Fitch downgraded the U.S. sovereign debt rating. Now, the White House knew this was coming. They were warned beforehand, and they were pissed, folks. So what do you do when the U.S. financial system begins to wobble? You tap the Oracle himself. Warren Buffett came out and said the following about the downgrade. Berkshire bought $10 billion in US Treasuries last Monday. We bought $10 billion in Treasuries this Monday. And the only question for next Monday is whether we're going to buy $10 billion in 3-month or 6-month T-bills. There are some things people shouldn't worry about. US debt is one of them. Now, we're going to come back to that statement in a minute, because if you didn't catch it, there's some truth bombs in there. But first, let's just be honest and agree this administration and all previous ones as well care above all else about appearances, how they are perceived. Not to mention polling at the moment has the president's job approval on the economy at dismal levels. This was the last thing that the administration wanted to happen. I want to point something out, though. When I first saw all of this happening, the immediate thought that you want to have is that our leaders get it and they want to fix it, right? The downgrade I'm referring to, as when you read the White House's response, it was brutal. They are pissed about this, but do they really care? Do they really want to fix it? Or is their anger superficial, pissed about the bad optics, negative perception on how it makes them look? Well, if you're wondering, if you're an eternal optimist and believe they're trying to do what's best for our country, you may want to reconsider. Take a look at this. We are right here, folks. This is the current level of U.S. debt today, around $30 trillion. Look where the CBO, the Congressional Budget Office, projects U.S. debt will be in 10 years from today. $52 trillion. With a T, folks, $52 trillion. That means that we are borrowing $5.2 billion every single day for the next 10 years. It also means from the first U.S. debt downgrade that happened back in August 2011, which if you remember that, I personally do, our politicians at the time were furious talking about our economy, spending, our fiscal discipline, all that kind of stuff. Well, from then until now, from that first debt downgrade back in 2011 to the second downgrade that just happened this past week, we borrowed $18 trillion. We went from $12 trillion in U.S. debt to $30 trillion in a matter of 12 years. Now, with all of that in mind, realize this. A day after the downgrade, the Treasury updated their borrowing plan yet again. If you remember in the last video or the video prior to that one, we reviewed the insane level of notes and T-bills that the Treasury was planning to auction off this quarter. If you didn't watch that video, the Treasury has to report their borrowing plan every single quarter. Janet Yellen's plan, or the Treasury's plan that they released, was to borrow $1.007 trillion in just a single month, this month, the month of August, the highest level of borrowing ever with the exception of the pandemic. Well, since the downgrade, you'd think that they would have tightened up shop a little bit, announced ways to maybe cut waste and abuse, something, anything. But what did they do? They announced they're increasing the auctions a bit more. They came in a little bit low. So yeah, we have a problem, folks, obviously. Look, the fixed asset market right now is the most interesting play out there. Normally boring, small, tiny movements, but not now, not this year. It's been wild this year, and things are heating up, especially for MBS, mortgage-backed securities. We've been pointing this out since late last year, and it just keeps getting better and better. I talked about this on Twitter this morning. Prices for MBS continue falling, and it's funny because lots of hedge funds are starting to notice this. Funds who don't normally mess around with fixed asset type products, right? Not their cup of tea. But they're jumping into this, betting long on mortgage-backed securities, but they keep getting cheaper. So more people are buying, but they're just cheap, extremely, extremely cheap. Take a listen to Chief Investment Officer of Soros Fund Management. Yeah, this is the family office of you-know-who, can't say his name, but listen to what they say about this. Take a listen to this.
Right now, the asset class that we think is most interesting is actually typically a boring asset class, and that's agency mortgage-backed securities. And the reason for that is 2/3 about of your current holders, it's the central bank and banks have turned sellers. And you have a dynamic where you've had extraordinary interest rate volatility. So the valuations in that space have gotten, we would say, disproportionately cheap. But we think that asset class is probably uniquely interesting right now.
You're not the only person to say.
Now, that was 2 months ago. That video was from 2 months ago from today. Well, since then, they've gotten even cheaper, folks. Look at the spreads between them and their corporate bond equivalents, continuing to widen. And big funds, like I said a minute ago, have started to take notice of this. This is what Bank of America Global Research says. Money managers began adding MBS in Q2, some more active than others. The result, though, net adding as Q2 also saw the widest spreads in 21 years. But here's the thing, folks, even with these big money funds starting to buy MBS now, it's like a drop in the bucket for the kinds of volume that's out there. We are talking $40-50 trillion a year in mortgages. And what's happening right now, been happening since September of last year when the Fed stopped buying our mortgages. What's happening is a rebalancing of sorts. The MBS market is recalibrating, trying to find its fair value in the marketplace, because without the Federal Reserve to backstop the mortgage market, there's just not enough buyers, nowhere near enough buyers to fill the hole that they left, their giant gaping hole. And what does that mean in the short term? Higher mortgage rates, folks. We've been talking about this for months. Mortgage-backed securities are the bread and butter of residential real estate. They're what allow the housing market to go round and round. And you've probably heard, that mortgage rates move with the 10-year Treasury. Lots of people say this. And yeah, it's true. They kind of follow each other. But mortgage rates increase based off of investor demand for mortgages. That's what moves rates. Each time a home buyer gets a loan from a bank, almost always the bank does what? They turn around and sell your mortgage on the backside of the deal. You may not realize it, but your lender who took your loan packaged it up after you left, after they finished writing it. They packaged it up with other mortgages of similar size and credit rating tier, and they sold them off to investors. The same thing happens with GSE mortgages, government-sponsored type mortgages. If you're wondering, how that moves mortgage rates, well, when your lender gives you the money to buy your house, they have to sell your loan to stay liquid enough to have the money in-house to help the next home buyer who walks through the door. And here comes the important part. What if your lender can't find anybody to buy your mortgage? What happens then? They need to make it more enticing, so they offer a few more basis points to the investor, meaning that the bank makes a little bit less money and the investor makes a little bit more. And that's what's happening right now. Lenders have to keep raising the yield that they're offering to these mortgage-backed security buyers. Each time they do that, mortgage rates rise. And realize there's no rule or law that dictates how high mortgage rates can move over the Fed funds rate. It's all dictated by supply and demand in the credit market. They want to find a sweet spot of sorts where rates are low enough that there's enough home buyer demand to keep people looking for new loans, but also enough investor demand to sell your mortgage off after the loan gets written. Alright, if you enjoyed this video, got something out of it, press the like button. If you didn't, that's alright too, press the dislike button. Either way, I appreciate you watching.